Welcome back to Profit Fundamentals. It's one of the heaviest earnings day today. We've got a whole bunch of them coming out, starting with capital good names. We've got BHEL and Thermax both reporting today. Thermax in particular is selling off a little bit before those numbers. On the cement side, there's ACC and Ambuja numbers which should be coming. Those would be interesting as well. Both of those stocks, because of other reasons such as slight upside in cement prices, are trading positive. On the metal end, there's JSW and Sterlite which are reporting today, and again there's some anticipation of pressure on earnings for these metal companies. And then there's the big FMCG major ITC, those numbers come out today as well. So it's going to be a heavy earnings day. I'm going to move away from that though. There was an interesting report that Crisil put out yesterday suggesting that private Capex is on the down move, and the drop in private Capex will be as large as 35%. Joining us is Prasad Koparkar, Senior Director at Crisil Research. Sir, good morning. Thanks for joining us. 35% drop. Is this sort of worse than what had been anticipated perhaps last year?
Absolutely. In fact, when we decided to do this survey, we knew that the general sentiment is down, and as people say, that mood possibly was worse than the reality. So we spoke to about 200 companies, and what we found is that last year Capex was anyway down. It was down by about 4%. This year on an overall basis it was down by about 14%, but private companies are down by 35%, and I think this is one of the sharpest fall that we have seen in recent years.
And incrementally, sir, are there fresh problems that are coming up, or is it the same issue? Land acquisition, fuel linkages, perhaps interest rates to an extent?
Absolutely. I think, it was also very important to find out what is really hurting Capex. And therefore, we did a poll on 4 or 5 parameters and asked these companies to rank them. What came on the top was obviously government policy related issues. Almost 50% companies said that that is the number one issue which is hurting investment. 70% of the companies said that it is part of the top 2 reasons. Interest rates surprisingly came at a 3rd level. The second issue was global uncertainty and demand. And the least important issue, what corporate India is saying, is actually fund availability. So what I think corporate heads are saying is, in terms of a good project is there, funding is not a big constraint. And that is also visible from the balance sheets. If you look at corporate India's overall balance sheet, the gearing is still under control. Yes, there are pockets where there is a stretch, but funding doesn't seem to be an issue.
Which are the pockets which are, seeing the worst outlook in terms of Capex? Cement, textiles, why specifically those sectors, sir?
Right, you're right. Cement, textiles, telecom, automobiles, I think are the sectors where we are, at least in the poll companies, we saw the highest decline. I think cement, I would say, is not really policy driven. If you see cement, we had added about 60 million ton capacity in last 2 years. The operating rate for cement companies are at about 72 to 73%, which is very, very low compared to historical average of about 83 to 85%. So there I think it is more of demand supply issues. Textile again, I think the health is not very good, exports are down. But the heavy sectors, which are the heavy investment sectors, infrastructure is the big sector, right from telecom to port, power and so on. There I think it is the policy which is driving the investment down. In auto, for example, a lot of people wanted to set up diesel capacity, but given the uncertainty on additional excise duty on diesel, what will happen to diesel prices, we heard many companies in auto sector telling us that they are deferring their Capex for the diesel vehicles.
So, sir, in terms of sort of the cumulative economic impact of this, is there a way to judge how much this could shave off on GDP growth maybe this year, next year? Is there a way to sort of extrapolate it into a growth picture?
Yeah, clearly I think, there is not a direct mathematical correlation that you can establish, but we believe that, a consistent slowdown in investment will at some point in time even start hurting consumption. Today, if you really look at it, in India, almost 70% of GDP is coming from consumption, and that also will start hurting, thanks to also possibly the monsoon, but also investment cycle. So we believe that it's difficult to put a number, but GDP also will start getting impacted.
Did you get a sense from the people you surveyed as to what it would take to turn this around? In the sense, could it be a quick turnaround if just sentiment improves, or maybe interest rates come down a bit, or are these now sort of longer term plans being put on hold? In that sense, reversing this slowdown would be tough?
One factor, as you said, whether it is interest rate, there are 3 factors which people have identified, starting with policy action, and there we really don't know when many of these policy reforms which have been pending will be taken up. Global uncertainty, I think again on the global side, the outlook is not looking very pretty. Europe is possibly going to be zero or negative growth. US is also again showing some danger signs. So my sense is that policy action, some signal on the interest rate would help, but the recovery is going to be a little gradual.
All right, we'll leave it at that, sir. Thank you so much. Appreciate you taking the time to speak through that report. It's an interesting one. It tells you what's happening on private capex, which has, honestly been the biggest problem over the last year and a half in India, that we're just not getting private investment, and it continues to be a problem. That's all the time we have on fundamentals. We're leaving you the fairly volatile